You've been watching Intel's stock price swing like a pendulum on steroids. From $142 down to $19, then back up to nearly $100, all in the span of months. Your gut says this volatility means opportunity, but your brain whispers value trap. That instinct isn't wrong, it's just catastrophically incomplete. I've spent years tracking what happens when former market darlings fall this hard, and Intel's story reads like a case study in corporate whiplash. Here's what actually happened. Intel went from being the undisputed king of chips to watching competitors like AMD and Nvidia eat their lunch in AI and high-performance computing. The company that once defined Moore's Law suddenly couldn't keep up with it. But here's where the story gets interesting. While everyone was writing Intel's obituary, the stock just posted a plus 9% weekly recovery from what were clearly oversold levels. That's not random market noise, that's institutional money stepping in when retail investors are running for the exits. Take Stanley Druckenmiller. This is the guy who helped break the Bank of England and has one of the best long-term track records on Wall Street. He's still holding Intel, and so is Chase Coleman from Tiger Global. These aren't sentimental investors clinging to past glory, they're calculated predators who smell opportunity in chaos. When I look at Intel's current position, I see a company trading at what could be peak pessimism while sitting on $29 billion in cash and still generating substantial free cash flow. The RSI just hit a neutral 48.5 with a positive MACD crossover, technical signals that suggest the bleeding might finally be stopping. But the real question isn't whether Intel has bottomed, it's whether they can execute the turnaround plan that's already in motion. Here's where most analysts get Intel wrong, they're still analyzing it like it's 2015. The myth is that Intel is just a struggling CPU company getting crushed by Nvidia in AI. The reality is more nuanced. Intel is transforming into a foundry business while simultaneously trying to catch up in AI chips, all while maintaining their still profitable x86 business that powers most of the world's computers. This isn't a simple good company, bad stock situation, it's a complex restructuring play happening in real time. The foundry business alone could justify a higher valuation if they can capture even a fraction of the market currently dominated by TSMC. That's a massive if, but it's also exactly the kind of asymmetric bet that creates generational wealth when it works. But here's what keeps me up at night about Intel and what the bulls consistently underestimate. This isn't just about competing with Nvidia or AMD anymore. Intel is fighting a three-front war, trying to rebuild manufacturing credibility, competing in AI where they're years behind, and maintaining x86 relevance as ARM chips gain ground in everything from phones to servers. Even if they execute perfectly, the semiconductor industry is becoming increasingly specialized, and Intel's everything under one roof strategy might be fundamentally flawed in today's market. The recent -9% monthly decline shows that institutional patience isn't infinite, and if the next few earnings reports don't show meaningful progress on the foundry business, even the smart money might start heading for the exits. The next 6 months will determine whether Intel is a contrarian winner or a permanent value trap. I'm watching 3 specific catalysts. First, any major foundry wins that prove they can compete with TSMC for external customers. Second, concrete AI chip progress that shows they're not just throwing money at the problem. Third, and most importantly, free cash flow trends, because transformation stories are worthless if they burn through cash faster than they generate it. The current technical setup suggests we might see a test of that $102 AI target, but momentum remains uncertain for good reason. This is still very much a show-me story where execution matters more than promises. Here's my take. Intel represents exactly the kind of asymmetric opportunity that either makes careers or breaks portfolios. The case for a turnaround is real, strong balance sheet, smart money involvement, and a massive addressable market if they execute. The case for a trap is equally real: execution risk in a rapidly evolving industry where they're already behind. Rather than trying to time the perfect entry, consider Intel as part of a diversified contrarian bet, never more than you can afford to lose entirely. For the complete Intel analysis, including real-time AI signals and institutional flow data, check out nexusaicalls.com. Remember, this is educational analysis, not financial advice. Always do your own research and consider your risk tolerance before making any investment decisions.